You're watching Stock Watch this week. I'm Ndawling Lechela, and joining me to unpack your stock-related questions today via Zoom is Devin Shutte from the Rebay Group and Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Gents, thanks so much for your time this afternoon. Devin, June starting with some worrying prints, right? ADP numbers downbeat and a surge in jobless claims in the US. Does this point to a weaker labor market, or do we rather wait on those non-farm payrolls out later today?
Yes, look, I mean, the non-farm payroll numbers are key, right? That's going to give us an indication of how the US economy is holding up with all the tariff uncertainty, with the potential inflation that may or may not bring, and just all the kind of geopolitical risks thrown in as well. So really a lot for investors to kind of digest. So to your question, I would wait for the job numbers to kind of further sketch out a trend. But I think, you know, what we must do is pull the lens out of it and just see the last 2 months that we've managed to weather. April was a shocker, as we all know, and then May turned out to be one of the best Mays in the market in a very long time. So yeah, I think we are probably bound for more volatility, and I think really trying to tease out the signal from the noise is key. And yeah, right up to what you said up front, I think the jobs report is an important element of that.
And talking about signaling out the noise and that being key, are we all just applying taco trade at this point, Grant?
Probably. You know, I think from a news flow point of view, the peak pessimism is past. On balance, we're seeing incrementally more positive news, but it's not one way. So we're going to get some negative overnight tariff noise, but the teeth have been pulled out of that tiger somewhat already as well. So, you know, I'm somewhat more constructive. I think the rate outlook is looking a bit more promising for South Africa and potentially for the rest of the world as well. And so I think even the tariff impact is already being something in the rearview mirror for a lot of people, and it's really about how much of a permanent impact it has on the economy and how much is temporary. So that jobs number, for example, is it a one-off because of that moment when everyone was scared and paused, or is it the start of a persistent trend? And it's not clear yet which one that is.
All right, let's look at the US in particular. There's a question here on US equities, more of a comment. I think history suggests that the S&P 500 on average gives investors 10% per year, but this is on average and generally not from 20-time PEs. Any opinions by the panelists? I'll start off with you, Devin.
Yeah, sure. So, I mean, I think the viewers got it spot on. Is your starting valuation point is very key in determining what your long-term returns are. And, you know, despite the recent sell-off and recovery, we are above those Liberation Day levels actually already now. The valuations on the S&P are looking somewhat stretched. So I think you've got to bear that in mind. It's not to say that, you know, it's all fall down from here, but just maybe tempered expectations. Also, just another aside to that's fascinating. We're doing some work this week, and the S&P has felt like the only game in town for investors. You know, you've had the Mag 7 leading those up fantastically. But in fact, if you look at the JSE, in dollar terms, over 1 and 5 years now, it's actually outperformed the S&P, which I had to double check the numbers. But yeah, just goes to show that there's returns all over the show, even in an economy that's really struggling to get itself growing again. So yeah, fascinating stuff.
And the JSE has been quite resilient, Devin. I mean, you even look at other local asset classes. You look at bonds, government bonds, doing very well. The rand is sitting under 1780 at this point. I think the last time I checked, it was at 1774. Is this on the back of, you know, the rotation we've been seeing out of the US? I know gold and platinum companies, or rather gold and platinum prices have also been boosting the resources 10 complex, and that also filtering through to the all share, Grant?
Most definitely. I think we can't take too much of the credit. A lot of this has to do with a significant weakening of the dollar. But in conjunction with that, the stronger gold price is definitely helping our terms of trade. It's helping our cash balance, and I think there's other positives there as well. So the stronger rand in itself, then coupled with a weaker petrol price, oil price, and a falling petrol price, that's supportive of our economic and interest rate outlook. So we have got internal factors that are improving as well economically, and then on the global landscape, money is moving. Remember, just at the margin, the US economy and the stock market is so big that even if the flows soften by 10% and the money stops going into the US and a little bit more goes into the rest of the world where the valuations are far more attractive and growth is actually turning upward, whereas in the US it's tending downward, there's opportunity there. And so you're seeing that filter through Europe. France has massively outperformed Germany's at all-time highs. It's not just South Africa that's enjoying this bull market.
All right, let's stay within the US side. There's a question here on Tesla. Just following the fallout we saw between President Trump and the company's CEO, Elon Musk, weighing on the counter. I think the share price was down over 14% in yesterday's session. A viewer asking for your views on the counter and whether this is the right time to pick it up. Grant, I'll start with you.
It's depends on what you think. If you want to buy it as an automaker, I wouldn't buy it. I think there's a self-destruct button in full force there with Mr. Musk. But if you think there's value in the robotics and automation in the self-driving, which I believe there is, it's just very difficult to quantify and figure out when that value materializes, and AI as well. You can make a case for owning the stock. I feel like it's one of those where there's 5 to 10 year optionality here. It could literally 10x in the next 5 to 10 years, or you could be almost at naught on your money. So if you like that risk reward profile, and I think it is actually pretty attractive for some risk seeking investors, you could maybe allocate a bit there. Personally, I wouldn't right now, because of all the uncertainty.
Yeah. And looking at those shares, they were trading above $400, I think, in December, and now they're just over 284. Is that a company you're looking at, Devin, or would you rather, get into perhaps even the other Chinese EV players?
Yeah, look, I mean, one thing we do know with a mercurial leader like that is it's going to be volatile, and it's an incredibly divisive stock amongst the investment community. There's some hedge funds that have got big shorts on it, and others that are very, very strong believers in the long-term future of this company. Look, it's proving its volatility. You mentioned 284. I think in pre-market it's back all the way to 300 now. So you're in for a bumpy ride. From our perspective, I tend to side with Grant on kind of the more data and robotics side of things, but the future is just too unclear for us in this, too volatile. So it's one we watch with interest, but not one we're putting into client portfolios.
All right, there's a question here on a local counter, capital appreciation. I'm not sure if anyone looks at it, and the viewer asking on your take on the small cap divvy paying stock. Or rather, paying stock. Devin, let's start with you.
Yeah, so I mean, it's someone that we follow too closely. What I will say though is that these small cap counters, because of the kind of negative sentiment in SA Inc. in general, have just been vastly ignored. And so what that means is you've got really low liquidity in the counters, which can be a drawback. But what it also means is that they can also be sincerely underappreciated in that regard. So I think with that being said, some of them are also, paying some pretty nice dividends. So it pays you to sit in them long term. But I mean, this is really a fintech company that we think is quite interesting. It helps with things like regulatory compliance, payments platform, that type of thing. And so we think it definitely has a place. The only reason probably why we aren't more enamored on it is just purely on the liquidity side. But I think, depending on your time horizon for an investor who's willing to sit and wait, there definitely some stuff to look at here.
All right. Are you seeing value there in capital appreciation, Grant?
So it's too small for us to own, but I will say that small caps love bull markets, and at some point people will start looking for the next cheapest thing, and these small caps could deliver really good returns. I have looked at this company a couple of years ago. I think it's a good little business. The point of sale tied with software businesses is a nice business. They've got a good management team. And then they've also got their cloud software services business, which I think is very well positioned given the rollout of AI, etc. So I think it's a lovely little business. It's got a lot of cash. I think you could own it. I don't, and we don't own it. It's too small, but I think it's a good company and it's got a good management team.
Let's zoom in on commodities, gents. What have you made of the rally we've been seeing in platinum prices, and that also just filtering through to some of the PGM counters on the JSE Grant? I'll start off with you.
Yeah, we are seeing a genuine uptick in demand, and probably speculation will follow. There have been numerous reports of late talking about supply deficit for the third year in a row. And those supply deficits alone don't tell you the story, because there's a lot of above ground supplies, there's a lot of recycling, etc. But at some point, the cost curve and the supply deficit starts to matter. And the slower uptake of EVs that's playing out versus hybrids, there's a number of things that are saying maybe there's a little bit of life left in this dog. Don't ask me to take a 10-year view. But you're also seeing increased demand for platinum jewelry in China. That's supportive. So I think there's a little bit of legs in the story. I think it's too close to the cost curve on the downside. And of course, the weakening dollar supports all commodity prices. So there's a few things in their favor at the moment. So for a shorter term or more speculative perspective, I think you could probably still continue to buy these.
Are you buying, Devin, or would you rather just take a wait and see approach for now?
Look, as I've said before, buying these single stock commodity producers is just incredibly difficult from a timing perspective and understanding the supply demand dynamics of the underlying commodity. But what you've got here at the moment is the spot platinum price moving nicely higher. And, with the operational gearing you get in buying one of these platinum producers, you get that magnified upside or downside if the opposite happens. And I think, those above ground stockpiles, inventories, that type of thing, from what we're hearing, those are starting to be kind of worn down, and that market to become quite tight in the next 12 to 18 months. So that kind of explains why you're seeing some life come back to what is a really tough sector at the moment. Similar applied to gold, although there's different dynamics to gold. That being said, and what bulls will also tell you is that the demise of the internal combustion engine has been overstated, and that EVs are not maybe going to just eat their lunch straight away, and so that there's more demand for a while to come there. Kind of wrapping all of that up, I think interesting at the moment. I think what you do see in these cyclical type of counters is when they start going, they can go for longer than you think. But we're pretty cautious on them just because of the inherent volatility.
A question here on Valterra Platinum. The viewer says there seems to be renewed optimism when it comes to Valterra, this after the demerger from Anglo. I don't know, I'd say that's mainly off of the platinum price, Grant?
The optimism around Valterra, it's partly that. It's partly there's been massive overhangs of shares. I think there was a lot of guys that front ran this offloading, and there was a big short interest that had been growing. So you're seeing that unwind. And of course, you typically see with a spin-off that they tend to perform well post-spin-off. And, I think the prospects are better now than they were before under the Anglo's stable. So, and of course, I think the majority of it is the PGM price. Because you look at the other PGMs, they're all moving. So, it's a blend of both.
I mean, you look at Sibanye, you look at Implats, those counters up, 2-3% today. I think yesterday Valterra was up 10%. When it comes to those counters, Devin, I know you're not really keen, but which one comes out tops? Where are you seeing value the most from those PGM players?
Look, I mean, Valterra is interesting for us. I think high quality assets, pretty low cost production there. So that's one we like. I wouldn't necessarily look at Sibanye, although it's probably, I think, around 60% platinum and the rest primarily in gold. I just think that kind of portfolio mix and a few operational issues hasn't really worked there. So, rather go for the pure play. And I guess, that's what Anglo American was thinking, really spin out this kind of pure play like they did with coal and allow investors to choose. And as you said, so far it seems like it's been really well received by the market.
And we've seen copper doing quite well on the back of the the move into green metals. I think even Harmony Gold said they would be acquiring a copper mine. I think it was last week or the week before. Just your take around, copper and miners' exposure to the mineral.
I think, yeah, copper is a great mineral to have exposure to, or it's a great resource. It's fundamental to the electrification that's playing out globally, that needs to happen to support the data centers and the AI rollout. It's fundamental to basically all new technologies, battery electric vehicles, and all traditional technologies as well. So copper is a metal for all seasons. I think the fundamental demand story is robust. And if you can find a decent mine that's got good operations and a decent cost curve, you want some copper exposure. And I think that's part of the appeal of an Anglo's at this point in time as well, which is, it's only got copper and iron ore now.
Yeah, and it's interesting to see what's been playing out in mid-tier miner Jubilee Metals, where they're considering selling off those PGM assets to focus specifically on copper. Just your take on that, Devin.
Yes, I'd echo Grant's sentiments. I think as a green metal, the demand is just very clear. Supply just not enough to keep up with it in the coming years. And so, I think for the likes of Jubilee, you'll cast your mind back to when BHP was on the acquisition trail to buy Anglo's copper assets. I think expect to see more of those type of moves happening in the market. And definitely people are going to be on the hunt for those higher quality, low cost assets.
All right, let's move over to the retail space, particularly clothing retailers. We had both Mr. Price and TFG out with numbers, both counters reporting record revenue. Clearly, South Africans are really spending on that new outfit in this environment. What have you made of those numbers? And maybe what's your preferred pick out of the two? I was looking at the share prices, and it seems like TFG got a better response from markets than Mr. Price. I'll start off with you, Grant.
So of the two, I think Mr. Price is a better quality business. They do what they do well. Their free cash flow conversion is excellent, and they're a really well-run business. I think TFG has the benefit of a more innovative management team that tends to be quite creative in their acquisitions. They've got some ambitious plans. I don't think they've always delivered that well on the capital they've spent. And at the moment, the foray into Australia is a bit of a drag. Both the results were good in SA. Mr. Price is only SA, and so that favoured them. And TFG needs to see a turnaround in Australia and the UK to support its turnaround. So I think they're both pretty good. I think of the two, I would pick Mr. Price, but I don't think you'll go far wrong with TFG at these levels in the current environment.
And your take on that, Devin, is there a reason why I guess TFG is up 2% and Mr. Price is down 0.4%?
Sure, and Tarling, I'm not too sure. I mean, I guess maybe what the market was expecting in terms of those results. I think I echo your sentiments that both of those results were very credible. I'm in the Mr. Price camp personally, but what was interesting for me was to see kind of the slightly different nuanced outlooks from the two companies. Foschini was really talking about seeing signs of improvement coming into the SA market, particularly whereas Mr. Price was a little bit more circumspect and cautious, but they did see that they would be able to outperform in a volatile environment going forward next year. And given what they've done in these results, where they were able to take additional market share, I would definitely back them to execute on that.
All right, sticking in the retail sector, question here on Spar. The viewer asking why the counter's share price is in the green. Are markets not perhaps, taking comfort in them selling those operations in the UK and I think it was Switzerland? That strategic reset coming through, is that what we're seeing playing out on a share price side, Devin?
Look, it might be, but I mean, I think, unfortunately, if you look at Spar as a group, it just seems to have been plagued by one misstep after the next. We had the IT rollout that went wrong. We had some governance questions, and now we've got the offshore impairments that have just really, really hurt them. And they're not the only South African company. And also I'm sympathetic to it, in an economy that has been flatlining for 15 years. These companies have had to go look for growth, but unfortunately it's been very difficult to kind of implement those successfully. So, yeah, I'm not too sure on the short-term movements, but I think Spar is increasingly going to have to do a lot more to earn back investor confidence, as it seems like these mishaps just keep on coming.
And are you seeing some value in Spar, Grant, or is this the competition too tough? I mean, we look at the likes of ShopRite, you look at Boxer, it really is tough competition.
I still think there's some value to be unlocked there, but it requires good execution. I think it's a good step to get rid of the Swiss and UK businesses that are not contributing, and it's going to free them up to focus on the SA operation, which is core to the business. Started to see some margin improvement come through. They've still got a lot of room to do things better. Of course, it is new management, and I think if they get it right, you can see some value unlock because they are cheap. But there is a risk that it's a value trap, and it's highly competitive. I think the online delivery space, ShopRite's killed everybody. They've been left for dead, but so has Pick and Pay. And so they're going to need to execute well. I do think the lack of focus or the lost focus from all these other ventures has hurt them. But this renewed inward focus could be just what they need. They'll get their SAP implementation right and start to see an increment in margins and stabilizing in the market share. So I think if you're a little bit patient, the entry point is pretty cheap, and there's probably positive risk reward here.
All right, and one more question before we get into stock picks. It's from the luxury sector. A question here on Prada. The viewer asks whether this is the right time for the group to be making acquisitions, especially as we've seen the luxury counters take a knock on the back of slowing consumption in China and the risks of tariffs. I think this is probably on the back of that Versace acquisition. And there was something else yesterday. I think they made an acquisition, a 10% stake in a leather goods company. I'll give that to you, Grant.
So I think timing-wise, it would have been a lot worse in the last, say, 6-12 months ago when luxury goods were flying and China had reopened, etc. So most luxury companies have had a decent pullback, and actually some of them have been beaten properly. So if they're smart about the acquisition, it's not a bad time. You have to look through the cycle. You can't buy at the top, so they're not doing that. So I think I can't say it's perfect timing. We'll only know in hindsight. I think it's not a bad time to be making strategic acquisitions.
All right, let's get into your stock picks. Where are you seeing opportunity at the moment, Devin?
Sure. So it's one that we've chatted about before. It's a Hong Kong listed sports retailer, Enter Sports, and it's actually one of the largest sports manufacturers in the world. Not necessarily well known as a company, but some of the brands are pretty well known and loved, like Salomon, Wilson, and Fila. I think what's really compelling is it's a dominant player in the Chinese market. They've got about a quarter of market share there, and you've got to remember that's an economy that's growing along at 5%. So there's an inherent growth there. They've got a really strong e-commerce platform, as you would expect in a market like China, and yeah, just a really strong company from a financial perspective, ungeared balance sheet, and commands significant margins, particularly on the e-commerce platform. So yeah, one we like, and yeah, one we're watching closely.
And what are you hanging your hat on, Grant?
So I do like that Enter Sports as well, just by the way. So one I'm looking at, and I'm talking, supporting what I said earlier, I like Mr. Price. That's my stock pick today. I think there's enough in those earnings to suggest, if you take a 12 to 18 month view, it still looks quite cheap, especially if we see further rate cuts, which I think we will. If we see further real wage growth, which I think we will, and we have, and you see this sort of unwinding of negative sentiment globally over time, you're going to find these stocks are going to offer attractive returns. So I think it's a good business, it's in the right place, and it offers attractive upside. So that would be Mr. Price.
All right, let's leave it there, gents. Thanks so much for your time this afternoon. Thanks to my guest, Devin Shutte from the Rebay Group and Grant Nader from Benguela Global Fund Managers. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's it from Stockwatch this week, but do stay tuned for lots more coming up right on Business Day TV.